Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu. And on today's show, we welcome Phillip Streible, who's Chief Market Strategist at Blue Line Futures. Welcome to the show, Phillip.
Yeah, thanks for having me.
Let's begin by talking a little bit about gold. In a recent note, you suggested that with fresh record highs in equities, that it might be a smart time to ease into more defensive assets like gold and silver for long-term investments. So tell us how gold fits into your investment thesis. Is it purely a defensive play in your view when compared to the general equities?
Yeah, I think so. I mean, here's the thing is that you have U.S. equities at fresh high. You have Tesla today cresting over $900 per share, and you've got the valuations on many U.S. equities are just blown completely out of proportion. They have no sales to back it up. They have no actual real product. You're looking at, companies like Uber trying to decide, are they in the transportation business? Are they in the technology business? It's just a lot of vagueness and a lot of gray area out there with U.S. equities being concerned. That's why I think a time to diversify into, not only precious metals, but also look at some of the undervalued commodities, the commodities that people use on a day-to-day basis where a constant level of demand is there. It wouldn't surprise me one bit if we saw a stock like Tesla get completely halved, or, a company like Peloton to just basically go bankrupt. So I think that investors have a very risky, part of their portfolio being exposed by being long equities at these levels.
Okay, and if we talk a little bit about cannabis and crypto, those markets have fallen for quite a while now. Let's just say the frenzy surrounding those markets has now died away. Will that leave a space for commodities and speculations such as the junior mining stocks to fill their place?
I have to say, though, that cannabis and also cryptos, they're going to be here to stay. It's going through a consolidation period. It seemed like every person and their brother knew somebody who was growing cannabis here. But I do want to say something is that they released the January figures for the state of Illinois. We just started selling cannabis this year, and they had sold $39 million worth of sales to adults, and 20% of that was tourists. A state like Illinois has been fiscally in trouble for a long time, and this will help out the state as a whole, not necessarily the little individual companies that are out there in the stocks. As far as cryptocurrencies are concerned, I think that there's definitely a need there. As far as, let's say you are in Wuhan in China, you need to get your money out fast. How it wouldn't be difficult at all to move all that to a Coinbase account, then relocate somewhere until the dust settles, and then still have access to your money. So these things have needs that are there. Now, as far as metals are concerned, I think that metals are going to benefit from some of these alternative assets starting to decline. People will say, hey, maybe some of these cryptocurrencies aren't so good. Let's park our money into hard assets like gold and silver. So I think that there is a little bit of a sector rotation between those three asset classes, but they're all here to stay.
Very good. Okay, well, let's talk a little bit about your career. You've spent more than 16 years working with clients within the financial sector, and where you've mainly focused on the metals, currencies, and agricultural markets. So back when you started, give us a sense of what the commodity markets were like back then, and how do investors see commodities today? Do they see them as an unloved opportunity? So
back in those days, like 2002 to 2005, commodity values were hardly anything. The dynamic of how people executed orders was completely different too. There weren't electronic platforms then. Everything was done through the pit. We're located at the Chicago Board of Trade. You can go down there now and still see some of the pits are still quite active. So the ability for people to execute orders was much more difficult. So there were less people trading commodities. Commodity values were very low at that point in time. You look at things like, gold was $300-$400, silver was $4 or $5, oil was in the 30s, and all your grains like soybeans, they were $6 and $8. Now, what's interesting is that some of the values on certain commodities have continued to rise, head higher. A lot of it is how those commodities are controlled or who trades them right now. But if you look at other assets like corn prices, they haven't really gone anywhere in years. They're just a seasonal tendency where, it gets tight, they grow more, it comes back down. Where gold, I think, is gold. And if you look at like platinum, palladium, those have been much more of a scarce resource. So, especially palladium prices have gone absolutely through the roof as that demand is outpacing supply. So certain commodities have, really shocked, the average person looking over 20 years, where, other commodities are just a seasonal play back and forth.
Okay, and let's talk a little bit about the psychology of trading and investing. How do you get better at reading and trading the markets? Perhaps we can touch upon your views on human behavior within the markets.
Okay, so this is a really interesting topic, the psychological mind game that trading plays with people. And I completely changed my trading philosophy. And once I did that, I'd say probably about the first 6 years trying to figure things out. You know what most people do is they try and outsmart the market. So with US equities near these record highs, people are going to start short selling them. Okay. And what they want to do is they want to, be at a cocktail party and tell their friends, yeah, I sold the high in that market, or I picked the bottom in oil, or, and they try and outsmart the market. And when you do that, it might work once or twice, but man, you are just going to get ran over and burned. And that's what I'm telling you, that's what most people do, try and pick tops and bottoms in the market. I am a trend trader. When that market makes new highs, if it breaks a key psychological level, I will continue to add to that position. When things do feel a little bit long in the tooth, I don't get completely out of the position. I'll take it and diversify into other markets. That's why I'm saying US equities, diversify into other commodities like gold, like silver, like oil down at these lower levels here, and continue to maintain some long exposure. So, the trend, if you follow the trend, you will have a much better success in trading. Look at it like this. Look at it like there's a river flowing. It's a lot easier to just flow down the river, to just sit in a raft and go down it. If you try and fight the trend, try and fight the current, you might get 5-10 yards up, but it's going to overtake you and you're going to be washed away.
Yeah, I think the trend is your friend is one comment that a lot of people come up with, which sounds very simple, but I guess it's very effective. So are you surprised with everything that's gone on within the repo markets and perhaps the continuous money printing over the last 10 years? I would imagine gold and commodities should be a lot higher than they are today.
So what I look at is how interest rates as a whole, like globally. So over the last 12 months, globally, there's been over 80 interest rate cuts. You look at where the US is right now, we're floating between 1.5% and 1.75% on our interest rates. President Trump, he would like to see those interest rates continue to go lower because he thinks that it will continue to spur economic activity. I think that the Federal Reserve is standing their ground and not cutting rates because of the fact that that's kind of like the last line of defense. Once you get to zero, how much lower can you go? So what they're doing is they're participating more and more in the repo market. They're putting more assets. If you look at the Federal Reserve's balance sheet, it's continuing to expand, kind of at an alarming rate, staying off the radar, but it is an alarming rate. And with the repo market, what they're doing is they swap out these treasuries that companies hold, or individuals, hedge funds, they get cash brought in, they use that money, and that's what I think is artificially pushing up valuations on the US stock market. When the repo rate bubble occurs, that'll probably be the top in the stock market. So it's not necessarily with the activity in the repo market going to boost gold, because we're not seeing it right now. So you've got to look at how it's going to affect other markets. And I think that once that bubble pops in the repo, stock market comes down, people go into the gold market and search for safety.
Fantastic. Okay, as we begin to start to wrap up, Philip, are there any books that you could recommend to our listeners that have helped you throughout your career? And is there anything else you'd like to share with us today?
So that's a really interesting question, because of the fact that, like, last night I looked at 3 or 4 books that and I have an entire library at my house of books. I looked at 3 or 4 of them that I thought were, man, they held the secrets back in the day. But the reality is as your learning curve progresses, you start looking for, different books. I always believe that, being a trend trader, that reminiscence of a stock operator about Jesse Livermore, he would buy breakouts and he would continue to add to those positions as the market went. He's not a guy who's trying to pick the bottoms, pick the tops and things like that. And, that identifies with me. I look at other books that are out there. You could look at, Alexander Elder, Dr. Alexander Elder. He writes a lot of really good books, but they're more interviews on traders and how traders, trade. So like even with the Market Wizards books. So what you want to do is you want to read through these and you want to find trading strategies that complement yours and then learn from those specific people's mistakes. If you're looking at becoming a wide receiver for a football team, you don't learn from a quarterback. You learn from the other wide receivers that are out there. And I think that's what you need to do is identify traders that trade like you, follow them, learn from them, and they'll be more than happy to share the information with you.
Excellent. And just before we wrap up, maybe the Palladium market, can you talk a little bit about that? I think that surprised a lot of people, the strength over the last year at least.
Palladium's really interesting because as we see almost a war on emissions and these cleaner energies and the crackdown on emissions globally, you see demand for palladium and rhodium. Those are continuing to go up. You can add more palladium to a catalytic converter, and that will easily achieve the higher standards with regards to emissions, where if you start to add other components like platinum to it, you need to reformulate. It could take years of testing. It's not going to be approved by environmental agencies. That's why palladium continues to go up and platinum is just holding still. Now, back in like 2008 to 2010, somewhere in there, when rhodium peaked at like 10,100, it collapsed 6 months later. That saved the automotive industry from having to pass that cost along. That's why automotive makers are continuing to buy palladium, because it's not making a huge impact. And they believe that the market will right itself on just seasonal tendencies and palladium will come down. I think palladium prices are going to continue to travel higher, though, because of the current supply-demand structure.
Okay, very good. All right, well, many thanks for your time today, Philip. It's been great having you on the show.
Yeah, thanks for having me.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?